Welcome back to The Explainer. So today we are unpacking a wealth-building concept that honestly feels like a well-kept secret among Canadian homeowners. It's called the Smith Maneuver. Look, if you've ever looked at your mortgage and felt like it's just this giant black hole swallowing up your hard-earned cash, well, you're definitely not alone. So let's explore exactly how this strategy claims to completely flip the script and literally convert a standard, boring liability into an incredible engine for generating real wealth.
Okay, let's dive into this. Here's our roadmap for today. We'll start by looking at the dead money problem, move right into the core concept, and then break down the 6 steps to wealth. After that, we'll run the math and snowball, do a quick reality check on is this for you, and wrap up with your required financial team.
Starting with Section 1, the dead money problem. Stop losing money to the bank.
$430,000. Just let that sink in for a second. If you're carrying a standard $500,000 mortgage at a 5.5% interest rate over 25 years, that is roughly the amount of interest you're going to pay to the bank. And here's the kicker. Every single dollar of that 430 grand is just gone. Gone forever. You get absolutely zero back. The bank isn't giving you a gold star, and the government for sure isn't giving you a tax break. It is literally dead money.
But honestly, here is where the whole situation gets incredibly frustrating. On one hand, you've got the regular homeowner just watching that money vanish forever. But on the other hand, look at the investor. When an investor borrows money to invest, like through a business loan, a margin account, or a mortgage for a rental property, the Canadian government actually allows them to deduct that interest right off their income. Basically, the government is subsidizing the cost of their investing. It's a massive double standard, right? And it sparks a really profound question. What if a regular homeowner's mortgage interest could somehow be tax deductible too? Which brings us to Section 2, the core concept explained, a legal shift in debt. The absolute heart of this entire strategy boils down to one incredibly powerful idea. It, quote, converts non-deductible mortgage interest into tax-deductible investment loan interest over time and without requiring any additional money, end quote. I really want to emphasize that word right there. Converts. You are completely transforming the debt. And honestly, the most fascinating part? You're doing all of this without needing to dig into your pockets for extra out-of-pocket cash every single month. So, the crucial point is this. You are not paying more. You are not taking on more debt. Seriously, if your total debt is $500,000 today, it stays $500,000 tomorrow. You are simply changing the nature of the debt you already have, shifting it from non-deductible to deductible. But, how exactly do we make that happen in the real world? Well, it relies entirely on one absolutely essential tool, the re-advanceable mortgage. This right here is the magical linchpin of the whole strategy, and it is genuinely brilliant. Basically, it's a special mortgage product that combines your traditional mortgage with a home equity line of credit, or a HELOC. As you make your regular payment and pay down your mortgage principal, that exact same amount of money automatically becomes available for you to borrow again inside the HELOC. Think of it like a glass of water that just automatically refills itself from the bottom while you're drinking from the top. And major lenders offer these all the time. Products like Manulife One, RBC Homeline, or TD FlexLine.
Moving on to Section 3, 6 Steps to Wealth, the Execution Blueprint.
Let's walk through how this continuous self-feeding cycle actually works in practice. Step 1, as we just talked about, you go out and get that re-advanceable mortgage. Step 2, you just make your regular monthly mortgage payment, exactly like you always do. But Step 3 is where the magic really starts. The principal portion of your payment opens up fresh room in your HELOC, and you immediately re-borrow that exact amount. Step 4, you take those HELOC funds and invest them into income-producing assets. Think Canadian dividend stocks or ETFs. Now, because you borrow to invest, Step 5 allows you to claim that HELOC interest as a legitimate tax deduction. And finally, Step 6, you take that massive tax refund generated by those deductions and you dump it straight back onto your mortgage as a lump sum prepayment. What does that do? It speeds up your principal paydown, which opens up more HELOC room, which lets you invest more, generating an even bigger refund. It is an incredibly powerful continuous loop.
Up next, Section 4, the math and snowball, from tiny deductions to massive wealth.
Now, what's really interesting about this slide is the crazy contrast between day 1 and year 10. Let's assume you've got that $500,000 mortgage at 5.5%. In month 1, maybe only $400 of your payment actually goes to principal. You reborrow it, you invest it, and your tax deduction for that first month is a pretty comical $1.83. Try not to spend that all in one place, right? But if you stick with it to year 5, your deductible HELOC balance has grown to $50,000.
And assuming a 40% marginal tax bracket, your annual refund is now $1,100. Keep going to year 10, your HELOC balance is $120,000. Your deductible interest is $6,600, and your annual tax refund is sitting at $2,640.
And this brilliantly illustrates the exact snowball effect we're talking about in action. Every single year, more and more debt shifts from the bad side over to the good side. The compounding effect is actually awe-inspiring when you map it all out like this. By year 20, the tax refunds alone can literally shave years off your mortgage amortization. And hey, that's not even counting the actual investment portfolio you've been building up for 2 solid decades, where compounding returns could have easily pushed into the hundreds of thousands of dollars. You are quite literally building wealth using money that used to just disappear into thin air.
All right, Section 5. Is this for you? Let's do a quick reality check.
So let's juxtapose the ideal candidate against the, well, wrong candidate. Looking on the left, this strategy works best for you if you have a stable income, a long-term time horizon, and the mental discipline to weather market dips without completely panicking. It's also highly effective if you are in a higher tax bracket, say 33% or more, simply because your tax refunds are going to be significantly larger. Now on the right, who should absolutely avoid this? Well, if you plan on selling your home in the next couple of years, if your income is pretty unstable, if market downturns make you prone to panic selling, or if you just flat out refuse to use a financial advisor, stay away. For sure. This takes serious discipline and a lot of patience.
Now, I know exactly what some of you are thinking right now. Whenever we talk about strategies that generate massive tax refunds and shift debt around like this, an immediate question always pops up. Is this actually legal? Am I going to get audited and penalized by the government?
The short answer? Yes, absolutely. The Smith Maneuver is fully 100% compliant with the Income Tax Act of Canada. The ability to deduct interest on money that you borrowed to earn investment income is a very well-established bedrock principle of Canadian tax law. You are simply utilizing the exact same tax codes that wealthy investors and business owners use every single day. Thousands of Canadians execute this completely legally and cleanly every single year.
Which brings us to Section 6, your required financial team. Seriously, don't try this at home.
Because we definitely have to tackle the giant elephant in the room here. What if the market goes down? Investment risk is a very real thing. While your HELOC balance remains constant, the investments you actually bought with that HELOC can and will fluctuate in value. You could temporarily owe more on the loan than the investments are currently worth. And this is exactly why you need a long time horizon, and crucially, why you need absolute experts managing the mechanics behind the scenes.
To execute this safely and actually mitigate those market and compliance risks, you absolutely must have these 3 specific professionals coordinating together on your side. First, a mortgage professional to select the exact right readvanceable product and properly structure it for you. Second, a financial advisor to select the appropriate investments, manage your personal risk profile, and make sure your portfolio perfectly matches your timeline. And third, an accountant. This one is vital. They ensure your interest deductions are documented flawlessly and your filings with the CRA are absolutely pristine. Listen, if any one of these 3 professionals is missing, your strategy is incomplete and you are potentially putting yourself at real risk.
Which brings us to our final provocative thought. Will you let your mortgage interest remain dead money, or will you explore converting it into a wealth-building tool? The math is absolutely there, and the tax law completely supports it. If you want to see if this mathematical magic trick actually works for your specific life situation, a really great next step is just booking a simple, free 20-minute strategy call over at michaelqblair.ca. Don't let your money just die at the bank. Thanks so much for exploring this with me, and I'll see you in the next explainer.